Welcome to the Broker's Lounge with Eddie and Carlo. Disclaimer, the information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.
Welcome to another episode of the Broker's Lounge with Eddie and Carlo. And as usual, every week we try to bring in a new topic and talk about a different thing that might be helpful in the investment and property purchase journey. So, Carlo, how are you?
Yeah, well, good, mate. How are you?
Good to see you.
Likewise.
Yeah, another week.
We got through another one.
That's it.
What are we down? Six already for the year?
6 weeks, yeah, almost, yeah, man.
Crazy how time is flying by, but yeah, it's all good, which is the main thing. So
That's it.
We are moving along quite swiftly. So, look, today we're going to deep dive into a topic for property investors, one that a lot of people talk about, and ironically, there's some people out there who don't actually understand the mechanics behind all this as well. And I'm essentially talking about negative gearing versus positive gearing. So we want to give our spin on our views with regards to it. So we're going to break down how negative gearing and positive gearing affects your taxes, and whether it's going to, which one's going to be the best fit for your investment strategy. We're also probably going to go through some real life examples as well.
Yeah, so we'll try to shed as much light and explain how it works, what it is, and how you can use it, and give some examples. And
we've got a really good example of one that's worked for one of our clients just over the past 12 months. So
absolutely.
It'd be good to give a bit of shed some light on that one there.
Let's get it going. So if we are to start with basically what is gearing, so gearing is when you're taking out mortgage or finance to use towards purchasing a property.
Yep.
Now, when we say if the property is positively geared or negatively geared, it's basically saying if the property is making a profit or is losing money, making a loss. And the way you work that out is basically what income is the property generating from the rent that it's receiving versus the expenses that come with the borrowing and running cost of the property. If the bottom line is negative, then the property is negatively geared.
Yep.
And if that figure is positive, then the property is positively geared. And that's where investors play on that to see which property would suit them better in the strategy that they're pursuing. So
typically why would they even consider gearing in the first place?
Well, obviously every investment you make, you're going to have to make sure it has to be winning at a certain point. Yeah. Like no one invests to lose money. Okay. And I think it's a hack within our tax system to benefit from losses in your property and offset those against your taxable income. So that's why it's very important aspect of investing is investing in property, because if the property is making money, then that's great. Like you're making profit, but you're going to have to pay tax on that profit.
Yep.
If the property is making a loss and you're paying out of pocket, you can actually offset some of those losses.
Yeah, that's where the real benefit is, and especially for high income earners as well, where then you speak to a lot of high income earners. Their number one aim is to how do I reduce my tax, because I'm sick and tired of paying so much tax. So it's a great strategy to use to their advantage.
Absolutely. And if we are to deep dive a bit more into negative gearing, so maybe you want to
I think like you said, I think it's just, if we just break it down a little bit and just put a little bit more simply, negative gearing happens essentially when the income that you're generating from your investment property is less than what your outgoings are. So your outgoings are typically going to be the interest on your loan, council rates, utilities, whatever it might be. There's plenty of expenses that go with having an investment property. So if those expenses, so your outgoings end up outweighing or exceeding the income that you're getting from a rental point of view, that's typically negative gearing, because you're running the property at a loss.
Yeah, exactly.
Obviously, the benefit to that, as we just explained, was being able to utilise those losses. So, I guess if we give an example, actually we might jump into an example a little bit further down.
But maybe before the example, like what's the risk if the property is losing money?
Yeah, look, at the end of the day, you're typically banking, when you're running with a negative gearing strategy, you're typically banking on one major thing, and that's that the property will appreciate over time as well. So, if you end up with a property that's depreciating in value and you're also making a loss on it from an income point of view, that's your key risk there, because you're literally losing on both sides. So most people are happy to take a hit on the cash flow side of things, with the ultimate end game being that the property will appreciate in value over the years, and it takes care of itself from that point of view. So,
and I guess one more point to be mindful about is, if the property is making a loss, like, you have to come up with the difference to cover for those losses. All right, so you're very reliant on your income, or your cash flow, to cover for those losses. Like, someone needs to pay for the loss.
Yeah,
if you're paying a $3,000 mortgage plus expenses plus costs, and the property is making $2,000 in rent, someone needs to pay that $1,000 difference. And if your income goes down, or if you stop working, or if your income is not strong enough, or you've got no savings to cover, then that's where problems are.
And everyone's situation is completely different as well. You might have a couple who has just recently bought their own home, so cash flow is really tight as is. So a lot of people will go, you know what, I don't actually want to go with the negative gearing strategy. I'd much rather have a property that's going to pay for itself. We're happy to forego potential growth in the property over the years, so long as it pays for itself. And then even if we get a little bit down the track, it's better than nothing.
It's more like a piggy bank strategy than growth strategy.
Exactly right. Yeah.
So maybe
I think it's worthwhile coming up with an example from a numbers point of view, because let's just go through, say, an ideal client where we'll call her Sarah. I'm going to use a female.
My wife.
So there you go. She's earning $120,000 a year. You can stop working now, Eddie. She buys a property that brings in $25,000 a year in rent, but her expenses, like the mortgage interest, the maintenance, all things we spoke about earlier on, they total $35,000 a year. So end game is $10,000 loss. So, but how does that actually affect her tax? Well, the beauty is that on that type of income, she's in that 32.5% tax bracket. So that $10,000 loss is actually offsetting her income. So instead of paying tax on $120,000, she's actually going to be paying tax on $110,000. The net saving to her is that she'll save $3,250 in taxes. So if you look at the out-of-pocket side of things, $10,000 loss, but gaining $3,250 in extra taxes not paid. The net loss is about $6,750. So I know a lot of companies out there who are helping clients buy properties. They run the different cash flows, and it's all about what is your net out-of-pocket expense after taking negative gearing into consideration as well. So it's important to have a look at the bigger picture as well, because you can't just look at 100%. Just the simple numbers. So.
And to be honest, like, if you're buying an investment property, and obviously it's a long-term strategy, but if you're out of pocket by $6,000-7,000 a year, like, that's nothing.
No.
If you're actually, holding that property for 5-10 years, and the property is growing by 3, 5, 7%, like, it's nothing. Like, some people might think it's too much, I'm bleeding, but then maybe you're not ready to buy an investment property. But if you've actually got the income to cover that loss, then it's definitely a great strategy to use. So very good. So
should we flip it now?
Flip it into positive. Yeah. I'm the positive guy here.
Yeah, I'll let you run with the positive gearing. So thanks. You're saying I'm negative?
Oh no, I didn't say that.
All good.
So basically, like, it's whatever Carlo said, the opposite. That's it. No, so it's basically making the properties generating income. So like, your cost to hold the property year on year per year is like, let's say $30,000 a year, or 20,000, whatever that figure is. The rental income is covering that cost. So the difference is a positive income that gets added into your taxable income. So
that's essentially your downside risk. If you want to call it a risk as such, it's not really probably a risk, but it's
a good thing. Like, to me, the more tax you're paying, it's a good sign. Like, no one likes paying tax, but that means you're making more money somewhere. So that portion, which is the positive income you've earned, that gets added into your taxable income. So if we go back to Sarah's example, so $120,000 is her income, but the property has made a $5,000 or $10,000 property that gets added onto profit. That gets added onto her $120,000, and then she gets taxed on the full amount. So she'll have to come out of pocket with more tax to pay.
Yeah.
But the benefit is she doesn't need to worry about covering the loss throughout the year. So these are the main, I guess, differences. And
would you say positive gearing is less risky than negative gearing then, or?
Well, in general, if we're generalizing, yes. Yes, because you're not worried about covering the property's losses every month and having to compromise other things if you haven't got the income to do that. So it's risky in that sense, but as an investor, sometimes positively geared properties are a lot more riskier because you can potentially be letting go of potential growth because this is mainly how I see it. Like apartments are a great positively geared investments. You buy an apartment for $500,000 and you can get a good yield on it and it's positively geared. But then 10 years down the line, it's still the same.
The same value,
Rather than purchasing a property for $700,000, getting less rental yield on it, but then in 10 years, probably doubled in price.
I guess if you're looking at a property that's positively geared, there might be people out there who will go, I'd much rather take a property that's positively geared. Any surplus cash, I'll use those funds to invest in a different asset class.
Yes.
Than potentially looking to build their asset base in different asset classes. And you're right. They may not get as much capital growth on the property itself, but they potentially look to cover that by putting it into something different. It might be managed funds, it might be shares, whatever it might be.
Yes.
So that's just another strategy. People go, look, at the end of the day, every strategy has its merits. That's the important thing. There's no right or wrong way of saying, is negative gearing better than positive gearing?
Yeah, absolutely not.
There's definitely no right or wrong answer.
And I think it's very, very, very important to understand that we're talking about this in current interest rate environment. So these days, it's rare to find a positively geared investment property, especially if you've leveraged 80-90% of the borrowing against that property. But go back 3 years ago when interest rates were a lot lower, all properties were positively geared. Almost all properties were, because interest rates were very low. The mortgage repayment is the biggest expense for an investment property, So if all these properties are positively geared, doesn't mean that this property is not going to grow in value. Also, another important aspect, a property can be positively geared, even if it's a great property and grows with time, because the leverage or the loan against it is a lot less. Like you don't need to have 80 or 90%. Some people get into the property market with 50% deposit.
Yeah.
So their interest repayments are a lot less. So
and there's also the ability to have a property that has a positive cash flow, but still negatively geared, purely from the expenses that are driven out of that.
And that used to happen a lot in the past.
Yeah, apartments are a classic example, or towns where it might be, where you can actually claim, especially brand new ones, where you can claim the depreciation on the buildings.
100%.
For the first, was it 10 years on the building itself? So
building is 40 years, furniture and fittings are 10 years.
Yeah, so like I'm in that case at the moment where our investment property was newly built, so I've got a nice little depreciation schedule.
100%.
So cash flow might be positive, but if you can claim more expenses to bring that down into a negative gearing situation,
that's hit the jackpot.
Good scenario to be in, that's for sure. So.
100%. And that's why we always say it's ultimately down to your personal circumstances and what you're trying to achieve, because there's so many moving parts and different things to play around with to see what works for you. But from a investing point of view, don't focus if it's positively or negatively geared. Like this shouldn't be the focus if you're getting into the investment strategy, property, whatever.
Yeah.
Just go for the long run, what you're trying to achieve in the long run, not how I'm going to save $3,000 or $5,000 by the end of the financial year. So these are the main aspects of it. And what's like, if we are to talk about the long term capital growth example that we've had, if Sarah had purchased that property in 22, let's say, for $600,000, and we were very conservative by 3% growth rate. Usually properties worked on 6-7% growth rate annually. So in that 10 years, the property is going to be worth about $800,000. So she made a $200,000 equity profit on that property. And if we're working off $6,000 loss per year over 10 years, that's $60,000. So she still made $140,000 profit, and that's with very basic.
Yeah. And
numbers.
the other thing, obviously, to keep in mind as well is that, if you keep your property for more than 12 months, the HA obviously has the ruling that any asset that's graded that you've owned for more than 12 months, you have CGT or capital gains tax concession.
Yep.
So you're only paying tax on 50% of the gain rather than the full gain. So in her case here, what was the gain? $206,000. You're only be paying tax on half of that, and then
claim back. I think you can add back other expenses,
or the setup costs, etc. Yeah, well and truly.
So yeah, absolutely. This should be the main thought when you're getting into an investment property or an investment strategy. It's how it's going to be working in my favor for 5, 10, 15, 20 years down the line. Because especially with property, like property is a heavy asset. Like you can't liquidate it straight away, and it's expensive to get into at the same time. So, and the market, doesn't always work in your favor. Like we've had a good run probably during COVID and the year before COVID and the year after COVID, but then property pretty much has stabilized or didn't grow in the last year in certain markets. So that's why holding is the ultimate goal, and getting that capital growth over the years is the ultimate goal. And that takes us, I guess, to a client of ours who purchased that property up in Queensland last year.
Yeah, that was in March last year. So, but we were able to do another valuation just recently, and what was the end result?
Yeah, like they purchased the property for $640, and we did valuation, came back at $740. So $100,000 in less than 12 months. Like he doesn't care if the property positively or negatively geared. The growth is there, and the property is doing what's supposed to do. Like, tell me something that grows $100,000 a year. Like it's so hard to make $100,000 a year via work or income or whatever.
Well, even different asset classes like shares or 100%. Managed funds, like 100%. Typically they're managed funds are if you're getting 7 to 10% return, you'll be pretty happy with that.
Yes,
shares can be super volatile, so you could make 30%, you could be down 30% very quickly too. So
absolutely, and I think it's fair to mention, like, not trying to sell anything here, but this client who used a buyer's agent, all right, like a buyer's advocate, and obviously they know where to pick, which suburb to pick. They look into many aspects of why they've chosen that property, and to be honest, like that's a great result.
Just always comes back to the same old saying, isn't it, about buying property. It's location, and if you've got the right people advising you in terms of where to buy, you got the right people advising you around the right strategy that sits behind all that as well. So once again, buyer's agent, your accountant, your financial advisor, your mortgage broker, you get your team around you, and you can end up with in a really good position where you're taking advantage from all different aspects.
100%.
So from capital growth to tax, to getting a good interest rate, whatever it might be, to looking at the overall bigger picture.
Yes,
it's super important.
If those like team members are working together on the same level, same synergies, and absolutely, like we see it every day. Like we do bring value to the table, and working with like-minded professionals who do bring value. Like you've got a power team there, and they will help you a lot. Achieve stuff you weren't aware you are able to achieve. And I think there's power in that, educating people to do things they never knew they could do. And then the work is put in, numbers are broken down, emotions taken out of it.
Yeah.
Put that recipe
That's
together.
a big one, isn't it? Take the emotion out of it.
Absolutely.
And I think I was watching a video the other day, and it was a clear instruction. Unless you're buying your own home to live in, different story. There's a lot of emotion that goes into it. But if it's an investment property, if you've got any emotion in your investment decision, then you're stuffed. Yeah, you are stuffed, because you're not going to end up making the right decision, because it becomes purely a numbers game with the right strategy. So
absolutely. So I guess this probably runs through everything to do with positive and negative gearing, almost everything, just in case we forgot something.
Yeah.
So final thoughts, Carlo?
Look, I think it's just worthwhile wrapping up. Both strategies, both negative and positive gearing can be, great strategies to run with. One obviously has benefits on one side, one has benefits on the other side. But it's more around, like we said, just getting that tailor-made for your particular position, because not everyone's in the same position. For me, a negative gearing strategy might be great. For you, it might be the exact opposite. It might be work against you because cash flow might be an issue and you don't want to have those additional outgoings. So, well, I think that's a wrap for today, Eddie, and it's been a good, insightful session. Thanks again, everyone, for tuning into the Brokers Lounge. Continue watching our podcasts, subscribe to our podcasts, and leave us a review as well. That'd be greatly appreciated. So,
thank you very much. I appreciate your company, Carlo.
Any questions, please leave us some questions. Yeah.
Always.
All right.
Thank you.
Good to see you again.
See ya.
Thank
Bye.
you.